Assalamualaikum warahmatullahi wabarakatuh. My name is Irfi Medina Muslim. My student number is 2019-04-20-223. And I'm with my friend Tiara Ramadhani, and her student number is 2019-04-20-078. Today we are going to show you and present to you about types and method of company purchase. First, I want to explain to you about purchase method. So this purchase method is required resurface of the acquired assets and entities. So the simple word of purchase method is when the acquirer company purchasing the acquiree assets or shares. So it's called purchase method. So in this purchase method, the values of assets and liabilities should be measured at fair value. So we have to focus in the fair value. And then there are two types of company purchase. The first one is net asset purchase and the second one is shares purchase. The first one is net asset purchase. The net asset purchase is when the acquirer company, acquiring or purchasing the acquiring company net assets. So it's called net asset purchase. There's illustration 1 on page 15. You can open it on your book. I already wrote to you the important information here, which is the point company issuing 10,000 shares of $10 per common stock. The second one is the shares issue have a total market value of $610,000. Point incurs legal and appraisal fees is $40,000, which is it's like a acquisition expense. And then the fourth is stock issue cost of $25,000. So there is a balance sheet of Sharp Company. You can read it by yourself. And then the first thing you have to journal is the acquisition expense. The $40,000 of acquisition cost incurred by Point in carrying out the acquisition are expenses as incurred. So when the Point Corporation doing the acquisition of this Sharp Company, there is a cost of acquisition and it's called as acquisition expense. In here, the acquisition expense is $40,000 and we have to journal it with cash in credit. And then the second journal is the deferred stock issue cost or the stock issue cost journal. When the Point Corporation issuing the shares, they also have to pay the cost of stock issue. So in here, they have to pay to $25,000. In debit, the name of account is deferred stock issue cost, and in the credit, it's cash because they paid in cash. And then the third journal is Points record the acquisition of Sharp with the following entry here. The cash and receivable, inventory, land, buildings and equipment, patent, we can see from the book value from the fair value at the balance sheet. But how about goodwill? We have to know how to calculate the goodwill. So here is, I want to show you. So basically goodwill will be occur because there is an activity of a company being purchased by another company, where the price of the acquiring company is greater than the price of company worth, it's became a goodwill. But if the opposite, it's become negative goodwill, which is the purchase price of that company is lower than the net worth of company. Here is the formula of goodwill. You have to calculate the fair value of consideration minus the fair value of net assets. So from the illustration, we can calculate the $610,000 minus $510,000, and it became $100,000, and this amount became the goodwill of this acquisition. So after we know about the debit side, we have to balance it with the credit side. In credit sides, we have to record all of the liabilities. So here is current liabilities, common stock, additional paid in capital, and deferred stock issue costs. But there is additional paid in capital that we don't know before how much is it. Additional paid in capital that we don't know before how much is it. So here is the calculation. The additional paid in capital can be calculated by reducing the issued share with the stock issue cost. And from the illustration, we can calculate the $610,000 minus $25,000, and it became $585,000 because of Sharp already record the 100 par value as common stock as before. So the rest of the additional paid in capital became additional paid in capital. It's $485,000. Here, so we got the journal and we know how to get goodwill and additional paid capital. Okay, so now I want to show you how to record the acquired company. So here is, and the first journal. On the date of the combination, Sharp records the following entry to recognize receipt of the point shares and the transfer of all individual assets and liabilities to point. Okay, in the debit side, there is investment in point stock, which is the market value of the stock that they're issuing, and then the current liabilities from the book value, and then accumulated depreciation also from the book value. And there is cash, inventory, land, buildings, and equipment, and there is gain on sale of net assets. Okay, later I will tell you how to calculate the gain on sale of net assets in the next slide. Okay, the second journal, we have to write the distribution of point shares to Sharp shareholders, and the liquidation of Sharp are recorded on Sharp's books with the following entry here: common stock, additional paid in capital, retained earnings, gain on sales of net assets, investment. The credit side is investment in point stock. So how to get gain on sale of net asset? Okay, there is $210,000. It is the fair value of the excess over net identifiable assets, and then we added the goodwill, which is $100,000, and it became gain on sale of net assets. It is $310,000.
I will continue the presentation, and we will talk about the subsequent accounting for goodwill by acquirer. The acquirer records the goodwill arising the combination for the difference between the fair value of the consideration exchange and the fair value of the identifiable net assets acquired. After the acquirer records the goodwill should be recorded by with it IASC 350. There is a decrease in value. Goodwill should be reported as a separate line item on the balance sheet. Impairment loss for goodwill that occur after the recording of goodwill should be reported as a separate line item in income from continued operation in the income statement unless the loss relates to discontinued operations, in which case the loss is reported in the discontinued operating section. Goodwill should be tested for impairments at least annually at the same time each year, and more frequently if an event that is likely to impair the value of goodwill occurs. And next, we will continue the bargain purchase. In the illustration 2, the illustrate accounting for the bargain purchase assume that in the previous example of Point and Sharp, Point is able to acquire Sharp for 500,000 cash, even though the fair value of Sharp's net identifiable asset is estimated to be 510,000. In this simple bargain purchase case without an equity interest already held or non-controlling interest, the fair value of Sharp's net identifiable asset exceeds the consideration exchanged by Point, and accordingly, 10,000 gain attributable to Point is recognized. And you can see it in Journal 1. In accounting for the bargain purchase for cash on Point's book, the following entry replaced previous entry. Cash and receivable inventory, lands, building and equipment pattern in the debit side, and the cash current liabilities gain on bargain purchase for Sharp Company in the credit side. And for the situation opposite to that a bargain purchase, that is an overpayment. Acquirers do not knowingly overpayment for an acquisition. Any overpayment presumably would be result of misinformation, and the overpayment would not be discovered until a later time. The second one is shares purchase. The material shares purchase is combination effect through acquisition of stock. This is a first one of the material shares purchase. Any business combination are done by acquiring the voting right of another company rather than by acquiring the net asset. In such a situation, the acquirer remains, and the acquirer records the investment in the acquirer's common stock rather than its individual assets and liabilities. And for example, if Point Corporation exchanges its 10,000 shares for a total market value of 910,000, all of Sharp Company stock, and incurs 40,000 merger fee and 25 shares issue fee. And then the acquisition expense, defer stock issue cost, and cash itu tuh. Then the second one is financial reporting subsequent to a business combination. Financial statements prepared subsequent to a business combination reflect the combined entity beginning on the date of combination going forward to the end of the fiscal period. When a combination occurred during a fiscal period, income earned by the acquired prior to the combination is not reported in the income of the combined enterprise. If the combined company presents comparative financial statements that include statements for periods before the combination, those statements include only the activities and financial position of the acquiring company, not those of the acquire. And you can see the illustrate. Point Corporation had acquired Sharp Company in the middle 2011. Instead of at the beginning, Point would be include only Sharp earnings subsequent to acquisition and its 2011 income statement. If Sharp earned 25 in 2011 before acquisition by Point and 35 after the combination, Point would report total net income for 2011 of 335,000. That means 300,000 plus 35,000. Note that if the shares are issued in the middle of the year, the weighted average shares used in the EPS calculation would change as well.